Okay, this is basically a P2P, practice to pass, revision days first class, right? Okay, the objective is to teach you, to recall you things through questions, not through separate standards, right? Okay, so we'll start through different today. In today's class we'll be doing MCQs and OT cases. To start with, I have selected few new questions from your exam question bank, and these questions are available on accaglobal.com as well. You can take from me as well, and they are also available at accaglobal.com from recent examiner report, right? So these are the latest questions of like last attempt. So you can also take from accaglobal.com, and you can take from me as well, right? Okay, and now we need to do questions. We need to recall things through questions, the first objective, and we need to highlight the mistakes which students do now. But before this session, you must know these are revision days. You have done the normal course. You must have done the normal course. You have attended the normal course, right? Okay, but still I'll try to go very slow, and I'll try to recall maximum things in this session, right? Okay, so this is the first question of your examiner report. Peter Company, this is related to consolidation. The first question is related to consolidation. The first question is related to consolidation. Peter Company acquired 80%. 80%. The first thing is holding percentage of the issued share capital of Sono Company on 1st May X1. Few things you always need to highlight. That is, the holding percentage is important. That means the 80-20. Second thing is the acquisition date. Acquisition date is 1st May X1. Okay, because sometimes there are cases of mid-year acquisition or part-year acquisition. So acquisition date is very important. When the balance of Sono Company's retained earnings, see, this is acquisition date retained earning. This is acquisition date retained earning. In normal question, this acquisition date retained earning has its own importance because this is used in acquisition date net assets packet. Hope you remember this. And this is used for goodwill calculation as well. And one more thing, as this is acquisition date retain earnings, so you cannot calculate S companies post retain earning without this post retain earning. And S companies post retain earning is important for consolidated reserve and NCI both. For consolidated reserve and NCI both, please. Now, on 15th November 2008, see, acquisition date is X1, like 7-8 years back, and your reporting date will be after 7 to 8 years, right? On 15th November X8, Sono Company made 240,000 sales of goods. That means it's S2P sale, my dear student. It's S2P sale. Sono sold goods to P. S2P sale of inventory, not fixed asset. It's S2P sale of goods means inventory, on which Sono Company made a markup on cost of 20%. Peter Company subsequently sold 1/4 of these goods to external parties prior to 31st December X8. Very, very simple, very simple. Okay. So there should be some unrealized profit. Okay. And now you can also do it yourself. While I'm reading the question, you can also plan your thing as well. Now, how to calculate URP, the unrealized profit. How to compute URP? The simplest method is first calculate total profit, and then multiply total profit with unsold inventory percentage. You will get the URP. Now, can anybody tell me how much is the unsold percentage? Because one quarter, one quarter means 1/4 goods have been sold. 1/4 or 1/4 goods have been sold. That means 3/4 is unsold. 3/4 means 75% goods are unsold. So how are you going to calculate? URP for this question? How are you going to calculate URP for this question? Simply calculate total profit first through markup. And and then multiply 75% on that total profit, you will get URP. You will get URP, right? Okay. Now, one more thing. At 31st December exit, the retained earning of Potter Company, means P Company, is 4 million, and Sono Company is 3.4 million. Okay. So we need to make, let me use the word, we need to make acquisition date and reporting date packets of S Company, so that we can easily calculate post retained earning S Companies post retained earning, S Companies post retained earning, right? Okay. So let's do it. Just read the question, giving you 30 seconds more, and then I'll shift the screen. If you want to take the pic of this question, you can use your cell phone as well, so that the question is on another screen for you. Okay. Nope. After the class, I'll send you these pics as well. Okay. Let me solve it for you. This is acquisition date, retain earning. This is reporting date, retain earning. Okay. This is 3.4 million. That means 3400. 3.4 million. I'm writing with actual zeros. Okay. And the acquisition date retain earning was 520,000. 520,000. Okay. So first step, can anybody tell me what is S Company's post retain earning? Take the difference. S Company's post retained earning is 3400 minus 520 is how much? 3400 minus 520 is how much? It's 288. Okay, thank you. You guys also help me. Okay, right? So that I don't need to use the calculator anymore. Okay, this is your post retain earning. Now there is S to P sale. There is some S to P sale in this question. This is S Company, this is P Company. S Company sold goods how much? 240,000. Okay, 240,000 is the sales. And now let me calculate the total profit. Normally it's my approach. I calculate total profit using SCP approach, markup margin. I normally use SCP approach. It's your wish. If you want to use the formula, you can. There are different techniques used by different students. So it's SCP, percentage and dollars. In the selling price is 240,000. In markup, as this is markup, in markup cost is always 100, profit is 20. So selling price is 120. Selling price is 120,000. Can anybody tell me 240,000 is equivalent to 120%? Multiply by 20. How much is the total profit? How much is the total profit? How much is the I think it's 40,000. Am I right? Total profit is 40,000, correct? Yes, correct. Now at the year end, 25% goods are sold. Sorry, 25% goods are sold. That means unsold goods are 75%. 75% or 3/4 are unsold. So how you going to calculate URP? URP is total profit 40,000 times 75% is equal to 30,000. This is your URP. Now you have done the URP. You have done till URP. URP is 30,000. Now use your brain, little brain. You have done consolidation. As this is S to P sale, listen students, as this is S to P sale, that means the URP is booked by S company. URP is booked by S company. So it must be included in S company's post retain earning. So you need to deduct, let me change, you need to deduct this URP from S company's post profits. Okay. So now how much is left? 2880 minus 30. 2880 minus 30,000 is how much? 2850000. 2850,000, right? 2850,000. This is adjusted as company's post retain earning. Now, in this question, they are asking consolidated retain earning. The requirement is consolidated retain earning. I hope you remember this, and this is very easy thing. Consolidated retain earning is also called group retain earning. Consolidated retain earning is also called group retain earning. How do we calculate consolidated retain earning? Complete retain earning of P company at the year end. So I'll write first P company's retain earning. Complete retain earning is how much? I think it's 4 million. Thank you. It's 4 million. 4 million. Okay. And add S company's post retained earning, which is 2850 times the holding percentage, what's the holding percentage? Holding is 80%. Come on, times 80%. 2850 times 80%. 2850 times 80%. How much is this? 2850 times 80%. 228 thank you. 2280,000. Okay, so let's add it. This will be 6280,000. 6280,000. 62, the total amount is 6280,000. 6280,000. Okay, this is your consolidated reserve. This is your consolidated reserve or consolidated retain earning. Okay, that's the end of the question. That's the end of the question. Well, I say this question is not that much difficult. This question is not that much difficult. It's a routine question because in your class you do many questions, you do practice of such many such questions, right? Okay, for consolidated reserve. Okay, you guys got it? Okay, thanks. So I'm going to move to next question now. Next question. The answer is, let me write, the answer is 6280. Okay, right. Now, the next question is very, very easy. It's related to your basic course, the F3 course, the last paper you did. The last paper you did, it's related to F3 course. It's related to F3 course, the basic course you did in your life. Okay, IS2 inventory. See this. See the screen. You remember in IS2, we used to say this thing, we used to say this dialogue many times. Inventory should be recorded at lower of cost or NRV. Inventory should be recorded at lower of cost or NRV, right? Okay, so let's do it. At 31st December X4, at 31st December X4, Lich company had inventory of 100 items of work in progress which had cost 14900. Now wait. Let me make two columns. The first column I'll write cost. Cost is 14900. Okay. And the second column is NRV, net realizable value, selling price less cost to sell or complete. Selling price less cost to sell or cost to complete. Selling price less cost to sell or complete. So for 100 items, the original cost is 14900. Now open your eyes. This is the latest question. ACCAglobal.com says this is late. These are latest questions. Listen, it is estimated that the work in progress would cost $13 per unit. The work in progress would cost $13 per unit to complete. This is cost to complete. and that each unit would then sell for 166. Each unit would then sell for 166. This is the final selling price. Now, there is one thing more. Direct selling costs are estimated at 2% of revenue. You can think it as commission. You can think this cost as a commission. Okay. So in this question, there are two costs. Listen, the first one is selling cost, that is commission. That also you need to deduct. And the second cost is to complete the work in progress is 13 per unit. 13 per unit. So two costs you need to deduct from the selling price. Two cost you need to deduct from selling price. Two cost you need to deduct from selling price. Okay. Now you have two options. Either to go per unit, either to solve question as a per unit, or either to go total. Let me do it in the total form. I'm comfortable with total. Even you can do with per unit thing as well. Okay, listen. We have 100 units times 166. 100 units times 166 is 16600. This is your selling price. Now less. First of all, they are saying 2% of revenue is the commission. 2% of the revenue is the commission. Come on. 16,600 less 2%. Come on, deduct 2%. 16,600 less 2%. Do it. 16,600 less 2%. How much is this? Tell me. No. Less. Tell me the amount. Tell me the amount of 2%. How much is 2% of 16,600? How much is the 2% of 16,600? Come on. Oh, 332. 332 is the commission. 16,600 less 2% is the commission, and then less. How much is the per unit? How much is the per unit is the cost to, how much per unit cost to complete for work in progress is 13 per unit. It's 13 per unit multiplied by 100 units. So obviously it's 1300. Obviously it's 1300. Can you calculate the NRV finally? 16,600 is the full selling price, less 332 is the commission. I'm calling it commission. It's basically direct selling cost, and then 13 multiplied by 100. The number is 14968. 14968. Now use your brain. This is again a basic question. Listen, cost is 14900 and NRB is 14968. You can say this dialogue loudly. Inventory should be recorded at lower of cost or NRV. Inventory should be recorded at lower of cost or NRV. So which one is lower? This one is lower. This number is lower, number 14900. So answer is A. Answer is A. Again, this is a simple question, and this is the latest question, one of the latest question by accaglobal.com. Okay. Now, should I move forward? You got it? Come on, tell me. Okay. Good. Question number 3. Very good question. Which of the following ratios are likely to decrease? See the requirement. Due to significant revaluation gain on a depreciating asset. That means it's upward revaluation. Gain means upward revaluation. Okay. On depreciating at the start of the year. Okay. Now let's enjoy this part. This is very interesting part. The ratio analysis itself is an interesting topic. Let me write the formula. ROCE is basically return on capital employed. The ROCE or ROCE is basically PBIT divided by capital employed. PBIT divided by capital employed. And capital employed is basically total assets less current liabilities. Total assets less current liabilities, one formula. And there is one more formula of capital employed, that is shareholder equity plus non-current liabilities. There is one more formula of capital employed, that is shareholder equity plus long-term or non-current liability. That's also better. That's also better. Okay. Now, uh, second thing is gearing. Gearing. Let me write the formula of gearing. Gearing, they are saying use the formula debt equity. So it's debt means non-current loan divided by shareholder equity. Shareholder equity times 100. This is the formula of gearing. Next one is operating profit margin. Operating margin. Wait. This is basically, dear student, PBIT upon sales times 100. Okay, third formula. And finally, net asset turnover. This one is net asset turnover. Okay, this is basically sales divided by capital employed, and you can use the formula of capital employed as total asset less current liabilities, or one more formula, let me use here, shareholder equity plus loan notes, long term loan. Okay, plus long term loan. Now see, just wait, this is the real question. This is present, this is present in your examiner report. I always, I made short video on importance of examiner report. I always recommend students to read examiner report for each and every paper. So when you read this examiner report, you'll find this question. I'm giving you guys, I've written the formula, I'm giving you 1 minute, come on, solve it yourself, try it. Just think it's real life exam, and this is related to basic concept. Even in my eyes, F3 student can solve it, FA or basic fundamental level student can solve it. Come on, give me your answers. Give me your answers, come on, all of you, at least try, at least try. Write your answer here on the chat box. Write your answer here in the chat box, I can see. In the chat box, please, in the chat box. Only few students are right, only very few. Listen, let me solve it for you. Listen, wait. They are saying which of the following ratios are likely to decrease. Likely to decrease. The question is about decrease, right? The first ratio is return on capital employed. What they are doing, there is some upward revaluation. There is some upward revaluation at the beginning of the year. Now use your brain. When there is upward revaluation at the beginning of the year, so during the year there will be more depreciation expense. Because of upward revaluation, your depreciation expense goes up, and when your depreciation expense goes up, your PBIT will go down. See, your PBIT will go down. So when the PBIT will see the rows, when PBIT will go down, PBIT is in the numerator, so rows will go down. The first, the second thing. Now check the denominator of the rows. The denominator of the rows is capital employed, right? Okay. And what is the formula of capital employed? It's total assets less current liabilities. Now use your brain. When there is upward revaluation, so definitely your total assets will go up. When this is the case of upward revaluation, so definitely your total assets will go up. And when your total assets will go up, your capital employed will go up. And when your capital employed will go up, it's in the denominator, so rows will again go down. So in this question, there will be double reduction of rows, right? So this is a for sure thing. This is the for sure thing that your ROS will go down, your ROCE will go down. So one is absolutely correct. Point number one is absolutely correct. Now come to point number two, gearing. Gearing means here debt equity ratio. So it's the formula of gearing is loan divided by equity times 100. Loan divided by equity times 100. Loan divided by shareholder equity times 100. Now because of upward revaluation there is no change in loan. Because of upward revaluation there is no change in loan, but yes, because of upward revaluation your equity goes up. Your revaluation reserve is the part of equity. So when your shareholder equity goes up, see, when your shareholder equity goes up, that means the denominator of gearing is going up. So gearing will automatically go down. Gearing will automatically go down, right? So point number two is also correct. Point number two is also correct. Point number two is also correct. Absolutely correct. Because of upward revaluation, gearing goes down. Gearing goes down. Even in my notes, I have written this. In my lectures, I have covered this, right? Now the third thing is operating profit margin. Listen, listen, listen. What is the formula of operating profit margin? What is the formula of operating profit margin? PBIT upon sales times 100. Now, because of upward revaluation, there is no connection with sales. Upward revaluation has nothing to do with sales. Upward revaluation has nothing to do with sales. So leave it. No change in the sales. No change in the sales. But yes, as there is upward revaluation at the beginning of the year, so during the year there will be some increase in the depreciation expense. During the year there will be some increase in depreciation expense, and when depreciation expense goes up, your profits, your PBIT will go down. So now just think, as your PBIT is going down, so PBIT is in the numerator. PBIT is in the numerator, so definitely your operating margin will also go down. Definitely they will go down. So third is also correct. Third is also correct. Third is also correct. Third is also correct. Okay. Now, my dear students, point number four. Point number four, net asset turnover, or we call it asset turnover. The formula of asset turnover is sales divided by capital employed. Sales divided by capital employed. Now, because of upward revaluation, there is no impact on sales. Because of upward revaluation, there is no impact on sales. But yes, because of upward revaluation, your shareholder equity goes up. Because of upward revaluation, your shareholder equity, as the because of upward revaluation, there will be a new revaluation reserve. There will be some new revaluation reserve. So your shareholder equity will go up. And when your shareholder equity goes up, see this, when your shareholder equity goes up, your capital employed goes up. Your capital employed goes up. And when your capital employed goes up, it's in the denominator. It's in the denominator of asset turnover. So your asset turnover will go down. So now point number four is also correct. So 1, 2, 3, 4. Answer is A. Answer is A. Answer is A. This is all about concepts. This is all about concept. Even sometimes we discuss such things in our F3 paper. This was general question. You all should not lose marks on this. These are cash marks. Did you got it? You guys understood it? Please reply. Be quick in replying in the chat box. Come on. It won't cost you. Now this one is very good. This one is very good. This one is very not good. It's very good. It's very good. I like this question. Okay. Now, can you see the screen? It's little bit blur because I just copied it. It's little bit blur, but can you see this? Can you read this? Is it readable? Okay. Now, first thing is group 1 and the second one is group 2. Second one is group 2. You just have to find out, listen the requirement, identify two associate companies. In the first group, there are three points. In the first group one, there are 3 points. One is associate, pick it up. In the second group, there are 3 points. One is associate, pick it up. Okay. Now, let me tell you one thing. Let me tell you one thing. Listen. If you have studied the consolidation chapter properly, even with theory, listen. So I always say to my student that in the ending class of consolidation, we always teach this theory of IFRS 10. Listen, for subsidiary, the real thing is not holding percentage, the real thing is control. For subsidiary, if you want to make if you want to be a parent company and make other company subsidiary company, then you must have control. So the real thing is control. Real thing is not holding percentage, but generally we says when we have 50% plus, when we have 50% plus ordinary shares of another company, we have control, right? Okay. But yes, there are exceptions. There are exceptions. When you have less than 50% shares, then you have control. Okay. So the real thing is control. For consolidation accounting, for adding together accounting, for consolidation adding together accounting, the real thing is control. The real thing is control. Now, second thing is associate. For associate accounting, normally we say 20 to 50. We say this, we write this in class, we write this is this in class 20 to 50. Whereas for associate, we normally write this in class 20 to 50. But yes, we do teach these things as well, that this 20 to 50% is okay, but the real thing for associate, open your eyes, is significant influence. The real thing for associate is significant influence. Okay. And what is the definition of significant influence? Listen to me, this may be a good revision for you. What is the definition of significant influence? Significant influence means power to participate in financing and operating policies of an entity. And what does it mean? It means that you have a seat in the board. For example, there are 10 directors in the board. There are 10 directors in the board. Listen to me. And out of 10, 2 or 3 directors belongs to me. That means I can raise voice. I can send my voice to the board. I can participate in the decision making, right? It's not control. I agree. It's not control, but it's significant influence. I can exert influence on the board, right? Okay. So for associate, dear student, for associate, the real thing is, for associate, the real thing is significant influence. For subsidiary, the real thing is control. For associate, the real thing is significant influence. Now, just for revision, you remember, if you don't have in if you bought the shares, of a company, and if you don't have control and significant nothing, you have no control, you have no significant influence, then that investment is called trade investment. Okay. So there are 3 levels of investment. Control is the peak level, control is the highest level. Then you have, dear student, then you have significant influence, and then you have trade investment. Okay. So now in this question, you need to pick significant influence. And for significant influence, you must have, giving you shortcut idea, for significant influence, you must have somebody who can send your voice to their board. That means you have few directors, in the board. This is the general idea. Okay. So you can, in the first group there is one company, in the second group there is one company. Giving you 1 minute, come on, do it. 1 minute for you guys. Do it, come on. I've just recalled you. Okay. Let me tell you. The group one, let me enlarge it. The group one so that you can read it easily. Acquisition of 10%, 10%, apparently 10% means no significant influence and no control apparently, but let's see. Of RT's company, and we are Zuckal, right? Zuckal company has no representation on the board of RT's company. All decisions are made at board level. See, we have nobody in the board. That means neither we have control nor we have significant influence. So this is basically trade investment. This first line is basically trade investment, right? Now the second thing, acquisition of 40% of Banduka company due to an agreement with other shareholders. Z company effectively holds 52% of the voting rights. We have more than 50% voting rights. So that means nobody can challenge us. Nobody can challenge us in any decision. This is control. So this second company is your subsidiary. So obviously one is left now. Acquisition of 50% of the Castor company. We are Z company. Zuckal has appointed two of the five board members. Yes, out of five members, two belongs to us. Yes, we can send our voice. This is our associate. This one is associate. So for group one, the answer is this third company, that is Castor company. For group one, the answer is Castor company. Okay. Now group two. Wait. Acquisition of 21%. Apparently 21% means 20 to 50. 20 to 50. But there are cases when you have more than 20% shares, but still you don't have significant influence. Wait. Acquisition of 21% of D company. However, the other 79% of the D companies is owned by Yenti company, Y company, a company with no links to Zuckal company. That means there nothing is written. There is other party who totally controls the board, and we don't have any representation. There is nothing written about the representation in the board. There is nothing written about our representation in the board. So this is just your trade investment. You don't have control. And you don't have significant influence. So this is your trade investment. Right? Now, second company, acquisition of 70%. 70% is 50% plus of E company. Z company has been able to direct the operating policies of E company for many years and exercise that right. Yes. Okay. So we have the power, and we have the power to exercise the financing and operating policy. So yes, this is control. This is simple control. This is very simple control, right? Now, acquisition of 15% of F company. Zuckal company can appoint. Now, apparently, this is 15%. The third point apparently is 15, which is less than 20. But let's see. What we have. Z company can appoint one of the F company's five board members. Out of the five board members, we'll appoint one. So we'll have voice in the board. We can participate. In the decision making. So yes, this is significant influence, and this is your associate. Right? So this was very good question. So in the second group, we have F company as associate. In the group one, we have C company as associate, right? Okay. This was one of the good technical question, and normally students do mistake here. So my final words here. Listen to me. Final words. Final words are holding percentages are not everything. Holding percentages are not everything. Listen to me. For subsidiary, the real thing is control. For associate, the real thing is significant influence. And for trade investment, you don't have control, you don't have significant influence, then the balancing is trade investment. And I hope you guys remember, for trade investment, we apply IFRS 9. For trade investment, we apply IFRS 9. And for trade investment, there are two categories: fair value through PNL and fair value through OCI. Fair value through PNL and fair value through OCI, right? Okay. There is one question, let me tell you. In MCQs, you may get 50% marks. In MCQs, the first 15 MCQs, that means the first 30 marks, you may get half max in MCQ. But in OT cases, the three OT cases, in the three OT cases, that's very risky. If you do a mistake, complete zero or complete two. Complete zero, complete two. It's total gamble. It's total gamble, right? So OT cases area is very sensitive. OT case area is very sensitive. Be very careful with that area. Now, you, in in the website of ACCA, they have given this OT case as well, IFRS 15 OT case as well, IFRS 15 OT case as well. Okay, so and the OT case is not that much difficult if you have studied IFRS 15 before. If you have studied, provided. But if somebody doesn't know about IFRS 15, then definitely it's a new thing for them. Okay, so let's do it. The following details, the following details relate to three of Campbell's company's contract. Now this one is very clear. This should be very clear for you. Contract 1, the total price of contract 1 is 9 million and commenced in 2007. The total costs are expected to be 7 million. The progress towards the completion is assessed at 90%. This is basically, see, this is your SOC. Your stage of completion is 90% at 31st December X8. Progress was measured at 20% for the year ended 31st December X7. Okay, that means this contract was started in previous year, not this year. Just assume we are in, see the requirement, we are in December X8. We have to solve this question for December X8. We need to solve this question for December X8. Okay, and what they are saying, that the contract started, commenced in 2007. So now listen to me, hope you remember these words. Now we need to do cutting. If you want to do December X8, you need to calculate, you need to do cutting, you need to do cutting, and you need to calculate the balancing thing. You need to calculate the balancing thing. Okay, one more thing I would like to tell you, write in your register or in your paper that stage of completion is always as at. Stage of completion is always as at. Write it somewhere. SOC, this 90% is the, and the 20% is always as at these, that means to date. Okay, so can anybody tell me, it's very easy. Last year, by the end of 2007, by the end of 2007, we completed till 20%. We completed till 20%, and by the end of 2008 we completed 90%. So what is the for the year stage of completion? What is the for the year? It's 70%. We did 70% work this year. We did 70% work this year. Okay, now, examiner also wrote comments on this, that what mistakes students did. Now wait, I know first we should do question number 1, but I'm starting with question number 2. Read this. Question number 2. What revenue should be recognized? What revenue? Open your eyes. They are not asking profit. They are asking revenue. They are not asking profit. They are asking revenue. Examiner openly wrote this comment. Some stupid students, they gave answer for profit. Where did they ask profit? They are asking revenue. So please deal with revenue only. No need to discuss profit now. What revenue should be recognized in respect of contract 1? Contract 1 in Campbell's company's statement of profit and loss for the year ended 31st December X8, for the year ended 31st December X8, for the year ended 31st December X8. So now how we will do it? Okay, giving you 1 minute. It's easy requirement. This is not difficult requirement. Giving you guys 1 minute. Come on, try it. Okay, let me try it. Let me try for you. Let me try for you. I'm getting right answers here. Very good, very good. Listen, see this. This is your 31st December X7, the last year X7, and you have 31st December X8 here. So how we do it? We do it by taking the difference. First, calculate the revenue as at this year. It should be, the total revenue is 9 million. The total revenue is 9 million. 9 millions times 20% is 1.8. So that means till the last year they have already booked 1.8 million. Till the last year they have already booked 1.8 million. And now for as at 31st December X8, listen my words, as at, I'm using the word as at 31st December X8, the SOC stage of completion is 90%. So revenue should be 9 million. Revenue as at here must be 9 million times 90%. It's 8.1. 8.1. Now can you use your brain? The as at revenue till 31st December X8 is 8.1. Total cumulative is 8.1, and last year we already booked 1.8. So just take the difference. 8.1 less 1.8 is, I think, 6.3. So for the year revenue is 6.3 million. Okay, so now you don't need to touch cost or profit, nothing. They're not asking. They are not asking. Why are you doing it? These are written in the, you can read the examiner report. Examiner has openly told this thing, that I have just asked the revenue, why you are entering in cost and profit? If you do it, you will fail. That's it. It's very simple. So this was easy marks. Okay, so we just did contract one. Yes, we can do directly. There is one guy asked this. For revenue, you can do directly 9 million times 70%, 6.3. In this question, it's okay. But for profit, you can't do directly. Because estimated cost changes. Total estimated cost normally changes year by year. So for profit, you can't do directly 70%. Somebody asked the question, I'm replying that, sir, can we apply directly 70%? Yes, for revenue, you can. But for profit, you can't, because by doing calculation of profit, there is one thing, cost, and cost changes with time. Estimated total cost changes with time. Okay, one easy general question for you. See this. Which of the following correctly reflects how revenue should be recognized? Stage 5. This is related to stage 5. I hope you remember the stage 5. Stage 5, book revenue. Stage 5 is book revenue. There are two statements. You have to identify true and false. True and false, correct or not correct. The statement 1 and statement 2. Giving you 30 seconds. Come on, start. 30 seconds. Very good, very good, very good. Listen, revenue should be recognized as an entity satisfies a performance obligation. Yes, this is total correct. Total correct. Booking of revenue is dependent on performance, on the satisfaction. Listen the word, on the satisfaction of performance obligation. Listen, sometimes performance obligation is satisfied on time, immediate, one shot. We provide goods, we take the advance for goods, and as we transfer the goods, complete performance obligation is satisfied. So sometimes you book revenue in point in time. Remember, point in time, one shot, one shot. And sometimes, like in teaching, like in teaching services, you provide gradual services. You provide gradual services with respect to time. So in that case, listen, you satisfy the performance obligation over time. Remember this. So this statement is correct. Revenue should be recognized as an entity satisfies the performance obligation. So first statement is 100% correct, total correct. Progress towards, read the second statement. Progress towards completion on a contract should be measured solely, they are writing solely means only, on an input basis. Very wrong. This is very wrong. This is wrong. Now you are restricting the IS. This is wrong. You know, even in the class your teachers taught you the input and output basis as well. If you have done the construction accounting, in construction accounting we use input method, cost incurred to date divided by total estimated cost, as well as output, value of work certified to date divided by contract price times 100, value of work certified to date divided by contract price times 100. Okay, so this second statement is not correct. Okay, now students, please, you are doing preparation, final preparation for your exam through this session. Okay, don't sleep at all. Contract 2 is a new thing. You know, in my class I always beg students to read the book, to read the study text. I always say read the study text, it's must. There are many things in a study text. If you have read the study text, you must have come across this case. Read this case. Now listen my words, let me tell. When the outcome of the contract is uncertain, whenever it is written that the outcome of the contract is uncertain, so now in that case, listen to me, you can only book revenue which is equal to the cost. You can't book extra revenue because there is uncertainty. So now you can only book revenue equal to the cost which is recoverable, recoverable. So now the revenue and cost will be same. Now the revenue and cost will be the same. Automatically you can't book profit. Automatically you can't book profit. So whenever it is written in the question that there is uncertainty of the outcome, so now yes, you can book revenue, yes you can, but that revenue should be restricted to the cost incurred which is recoverable from the customer. You can book revenue till that amount. Okay, this is all about this. Listen, now contract commence in December X8. It is expected to generate profit of 3 million. Okay, it is, see the statement, it is too early. See the wordings. It is too early in the contract to access the progress towards the completion. We can't say anything. There is uncertainty. Okay, so in that case, what is the rule? What IFRS says? You can book revenue, yes, equal to the cost incurred which is recoverable. Now Campbell means our company has spent 0.2 million. This is the cost, 0.2 million so far, all of which is expected to be recoverable from the customer when Campbell company sends its first invoice in 2009. Yes, it is recoverable. It is recoverable, and we are in 2008. But we will receive this amount next year. We will receive this amount next year. Use your brain. Not yet received. Not this 0.2 million, not in our pockets. This 0.2 million, not in our pockets. It's your receivable. It's your receivable. Okay. Because when you will send the invoice next year, then they'll pay you. Then they'll pay you. Right. So it's your receivable. This 0.2 million is your receivable. So now just do it orally first. How much, according to the rules, how much revenue you can book? Only equal to the cost which is incurred, and that cost must be recoverable. So 0.2. So you will book in this question, what you will book, listen, you will be booking, listen, look at here, revenue of zero point 0.2, you will be booking cost of 0.2, that means no profit you'll book, right? You will be booking revenue of 0.2, you will be booking revenue of 0.2, you will be booking cost of 0.2, and that definitely profit is zero. These two things you have to book. And now this 0.2 million you will receive, you you will receive from customer, not yet received yet. So this 0.2 million is something like your receivable, is something like your receivable, so that it's current assets, it's your current assets, it's your current asset. So three things you will be booking, in short, three things. You will be booking revenue of 0.2 million, you will be booking revenue of 0.2 million, you will be booking cost of 0.2 million, and you will be booking a contract asset, or I must say current asset, current asset of 0.2 million. You will be booking a current asset of 0.2 million, right? These three things you will be booking. Let me show you the question now. Let me show you the question. See this, read this. Which of the following items, which of the following items not would not be recorded? Read the requirement. Examiner especially see this is highlighted. Would not be recorded in the financial statement. The answer is D. The answer is D. Yes, we'll record the revenue of 0.2 million. We'll record the cost of sale of 0.2 million. We'll record the contract asset of 0.2 million, but no contract liability. So the answer for 3 is D. Answer for question number 3 is D. D. Answer for question number 3 is D. Okay. Now, question number 4. Question number 4 is about question number 4. If the amount is not recoverable, then you can't book the revenue. Sorry. If the amount is not recoverable, then you can't book the revenue. It's not allowed. Only cost. Now listen, and then you will be in loss. Then you will be in loss. Listen. Now look at me. Next question is related to stage 5, something about stage 5. I hope you remember such things. In FR paper, it's very common. It's very common that sometimes, for example, I'm selling a machine. Listen to me. I'm selling a machine. In one shot, I'll provide the machine to other parties. So for machine, I'll book revenue on time. I have provided the installation on the same day. I have provided installation service to the customer on the same day. So installation revenue will be booked immediately on time. But now I have given 1 year warranty or 1 year after sales service. So 1 year or 2 years after sales service will be provided over time. So I'm providing three things. Oh, listen to me. Machine immediate, installation immediate. So revenue immediate for both of for two of them, immediate revenue. But I'm providing 1 year or 2 years maintenance service after the sale. So that is definitely overtime. That will be an overtime thing. Okay, so not difficult, just a little bit active mind is required. See, contract 3, I've already made your ground. Contract 3, students, please see the contracts, see this contract. See this contract 3. Contract 3 relates to the sale of equipment to a customer for 2.36 million. Total 2.36 million, and highlight the date. Date is also very important. 1st July x8, that means mid of the year. 1st of July x8, that is means mid of the year. The sale included there are few things in this bundle. Included 0.4 million of installation. Okay, very good. And 0.2 million relating to 12 months after sales support. The equipment was installed on 1st July x8. It means on the same day, the day we delivered the equipment, the day we delivered the equipment. On the same day, listen students, on the same day we we did the installation as well. So for machine, for equipment, immediate revenue will book. For installation, immediate revenue. But for that after sales support, it's 0.2 million for 12 months. 0.2 million for 12 months. And we started our service from 1st July. So 1st July to 31st December, how many months? Come on, tell me. 1st July to 31st December, how many months? Tell me. 6 months. So half. So half of this 0.2 million, it's 0.1. Half of this 0.2 is 0.1. Okay, read it, I'll explain you. Don't worry. Read it, I'll explain you. Okay, let me explain you this. Wait. As this is 2.36, out of this 2.36, see this 0.4 is for installation. 0.2 is for that support. Now tell me how much. 2.36 minus 0.2 minus 0.4. 2.36 minus 0.2 minus 4.4, I think it's 1.76. Yes, this is for equipment. Okay, now my dear student, just use your brain. How many things we provided immediately? We provided this equipment immediately, we provided this installation immediately, but this support should be overtime. And as this support is for 12 months, and we have started providing support from 1st of July, so July to December, only 6 months. So we'll take only 6 months of this support. 6 upon 12, so it's 0.1. 6 upon 12 is 0.1. 6 upon 12 is 0.1, right? So how many things you can book in this year? You can book these three: 1.76, 0.4, and 0.1. 1.76 plus 0.4 plus 0.1. The answer is 2.26. This is your answer. Again, not difficult question. As per FR standard, this is controllable question. This is controllable. I have seen this question in your exam kit. This question is in your Kaplan exam kit as well. If you are alert, you have seen such question in your exam kit. And when questions are coming from exam kit, it's not a challenge. It's not a challenge at all. Okay, now the point number 5. Point number 5 is a total easy, very easy, very. In my class, I sometimes shout, I sometimes say this loudly, that in your law paper, if hope you have done F4, the law paper, in your law paper, you have studied that the right of agent is only commission. The right of agent is commission income. Right of agent is commission income. And I am sure you have done the question price well, or I think it's Quincy, or there is one more question really regarding agent Xtol, XTOL in the final account. In the final account, it's price well, Quincy, and Xtol. Yes. So there are some questions of agent and principal. The right, listen to me, the right of agent, the right of agent is only, the right of agent is only commission. Agent can only book commission as his own income. This is not fair, this is unfair that agent is booking the revenue of principal. Very sad, it's very bad. Okay, first thing. Second thing, we book revenue, we never book revenue when we get the cash. That's also wrong. We book revenue when we got the right to receive, when the agreement is done, when the sale is done, when you deliver the goods, when the customer accept it. That day is enough for booking sales. Obviously in your life you have done many time credit sales. You have booked credit sales many times, you have booked credit sales many times. Listen students, so no need to wait for the cash to come in your pocket. As as long as the agreement is done, as long as the customer is accepted, as long as you have delivered the goods, that's fine, that's fine for booking the revenue. Okay, read it. Easy marks, easy marks, I must say it's very very easy marks. Read, do it yourself, come on. Some students have done it, some students have done it. Come on, come on boys. Now listen. Campbell Company offers its customer an accessory for the equipment that it sells in contract 3. Campbell Company does not manufacture the accessory itself but has an agreement with the manufacturer to sell the accessory on the manufacturer's behalf. Manufacturer's behalf. So we are agent. We are basically agent. Campbell Company places the order with the manufacturer and the manufacturer delivers the accessory direct to the customer. The customer pays Campbell Company for the accessory and Campbell Company then deduct 3% commission. So see this line. This commission clearly indicates we are agent. We are agent before paying the manufacturer. Okay. An accessory is delivered to one of the Campbell's company's customer on 10th December X8. That means before the year end. Your year end is 31st December X8. Your year end is 31st December X8, which the customer has accepted. Yes, customer has accepted and will pay. No issue, no issue. Will pay 50,000. Don't worry about. There is a concept of credit sale in this world. There is a concept of credit sale in this world in many markets. So credit sale is good, no issue. So now tell me, the total sales is 50,000, but what's our commission? What's our share? 50,000 times 3%. 50,000 times 3%. This is how much? That's your commission. That's your commission. That's it. So we are entitled only for this commission. And yes, we can book as an income. We can book as an income. Now let's read the, which of the following correctly describe the Campbell Company should recognize this transaction? Number one, 50,000 should be recognized as revenue. Wrong, very wrong. Sorry, we are not principal, we are agent. 50,000 is not our revenue. 1,500 should be recognized as revenue when the accessory has been paid. Half correct. Yes, our right is 1,500, but we won't wait for the day of payment. This is again wrong. See, it is written has been paid. No need to wait for the payment day. 1,500 should be recognized as revenue by Campbell when the accessory has been delivered. Yes, delivered and accepted by customer. This is the correct answer. D is again wrong. D is again wrong. D is again wrong. So see, these all are the questions in your examiner report. Okay, and normally students don't read the examiner report. That's why I solve these questions, so that in through these questions we have covered some of the areas of examiner report, okay, right? But I always recommend students to read examiner report. All position holders read. Even the guy who scored 89 marks in the last attempt, my student, he also read the examiner report. That's a must thing. That's a must thing. Now we are moving to one more past paper, and I think it's not in your exam kit. This past paper is not in your exam kit. Yes, I'll share the examiner report on the WhatsApp group. Don't worry, I'll share. Listen, so dear students, listen. uh Now we are doing one September. It's this paper is also available on accglobal.com. It's September 16 past paper, September 16 past paper, right? Okay. And I think this is not a, if in these questions are not included in your exam kit. These questions are not included in your exam kit, so that's why they are new questions. So you can this will be a something new practice for you. Okay, you can take these questions from ACCA website as well, or if you say, I'll also provide you on the WhatsApp group. Okay, it's same thing. Now, first of all, this is related to the framework area. This is also included in your course. Do read the book. Do read this area from the book as well. It's included in my lectures as well. Now, which of the following is not a duty of IFRS interpretation committee? You know, there are two major roles. Let me write two major roles of IFRS interpretation committee. Listen and learn it. Listen and understand it. There are two major roles of IFRS interpretation committee. The first role, there are some standard with dual meanings. There are some standard with dual meanings. What dual or three meanings? There are some lines of standards, they have two or three meanings. So what the public does, public takes their own meaning, the meaning which is beneficial for them. So in this way they can do manipulation. So what IS board says, what International Accounting Standard Board says, that you will have to follow our standard as well as our interpretation. So when there are lines, there are standards with dual meanings or three meanings, International IFRS Interpretation Committee interprets the correct meaning, okay, to avoid window dressing. The first role. The second role, listen, defects in accounting standard. Sometime what happens, when International Accounting Standard Boards launch a new standard, when International Accounting Standard Boards launch a new standard, there may be some, as they are human beings. International Accounting Standard Board boys are human beings, humans. So there may be some errors in the, some small errors, some small problems in that accounting standard. So when these complaints come to the Accounting Standard Board, they immediately issues interpretation. They immediately correct that problem, they immediately fix that problem, and they issue interpretation. So this is the second role of interpretation committee, that if there are small defects in accounting standard, they just do it, they just correct it through interpretation. So these are the two major roles. First of all, dealing with dual meaning things, issuing interpretations, and the second is, if there is any small defects in the standard, they just correct it. But if there is a very big defect in the accounting standard, that means the whole concept of the standard is wrong, then with respect to time, standard boards issues the new accounting standard, like they launch IFRS 16. They simply change this, simply outdated IS 17, and they launch IFRS 16, they launch IFRS 15. You know the whole story. That's a separate thing. These are the two major roles. Now read MCQ number 1. MCQ number 1, come on, start. Which of the following is not? The first thing is to interpret the application. Yes, interpretation, their name is interpretation committee, their name, this is the role, this is yes, one of the role, but we have to pick not. Leave the B, C, and first read the C and D. To provide guidance on financial reporting issues not specifically addressed in IFRS. Yes, that means if there is some problem If there is some problem, they guide you. Yes, this is also their role. To publish draft yes, interpretations is their primary job. So yes, this one is also their job. So A, C, and D are their jobs. Now read the B. To work directly with national standard setter to bring about conversion. No, this is this thing, listen, this thing is the role of IFRS Foundation. This thing, if you read the book, this point number B is the role of IFRS Foundation. So our correct answer is B. Our correct answer is B. Okay, right? They don't have to deal with the national standard setters of different countries, and no, that's not their headache. Okay, got it. Got it. Tell me. Okay, thank you. Now, the next question is which of the following treated will be treated as a subsidiary of Polgo company? Out of these three, you have to pick. I just taught you very in detail in the last examiner report. I taught you this. Come on. You have 2 minutes to pick it up. You have 2 minutes. All of you, please participate. Please participate. You know, there is a special topic in your book. I always teach this topic, exemption from consolidation. For example, this is P company, and P company controls S company. But still consolidation is exempt. Sometimes it's exempt. And in past, this exemption topic was very large. IFRS board has given a lot of exemptions, but with respect to time, they have removed. Listen to me. You must know this thing. In past, not now, in past, when parent company and subsidiary company has had different lines of business, so consolidation was exempt at that time, but not now, because many accountants did manipulation. Many accountants did advantage of that exemption. Many accountants took advantage of that exemption, wrong advantage of this exemption. Now listen. So now, whatever parent company is doing is a bank or insurance company, and subsidiary companies in manufacturing sector. But if there is a control, yes, you have to do consolidation. There is no exemption. Which of the following will be treated as a subsidiary? As at the acquisition of 60%, yes, 60% is 50% plus. So if the examiner is silent, it's deemed control. 60% of Zacron's equity share capital on 1st March. Zacron companies activities are significantly different from the rest of Polgo group of companies. No issue. Whatever they are doing now, there is no exemption. Whatever subsidiaries company is doing and whatever parent company is doing now, there is no exemption. In past, there was exemption. So point number one is correct. Yes, it's your subsidiary. Number two, to the offer to acquire 70% of it's just an offer. It's just an offer, dear student. It is written, it's just an offer. The offer to acquire 70% of unto company's equity share capital on 1st November X7. The negotiations were finally signed off in January X8. No, I hope you guys have done IS10. You guys have read IS10 from the book. It's also, if you do take over after the year end, it's a non-adjusting event. If you acquire a subsidiary after the year end, it's a non-adjusting event. So non-adjusting event means no need to do consolidation at the year end. No finalization at the year end. Now, number three, The acquisition of 45% of Speed's company equity share capital on 31st December X7. Polgo is able to appoint only 3 of the 10 members. 3. No, 3 of the 10 members. It's significant influence. It's just significant influence. It's not control. 3, it's significant influence. It's associate. It's associate. It's not your control. Right? So only A is the answer. A is the answer. A is the answer. A is the correct answer. Okay, now we are taking a small break. We are just to refresh, but wait one thing, listen one thing very carefully. In your exams, as a teacher, I'm giving you this advice. Don't expect the whole exam as a piece of cake. Not possible. This is ACCA. This is a professional body. They give you new questions, and yes, there are difficult questions as well, and no need to score 100 marks. Sorry, you never score. So you just have to cross 50 plus. 50 plus is pass, 49 is fail. You have to cross. So yes, accept this reality that there are certain difficult questions in the exam. Like the next question we are doing, it will be a little difficult for them, for you guys as well. So get ready to lose marks. I sometimes say do some charity. Do some charity with the examiner. Give some marks. Don't worry. You have to, still you just have to cross 50. Be happy with this 50 plus thing. Okay, normally yes, students score 80, 90, they do score, but the first objective is not to fail. That's it. So get ready, be happy during the exam, be happy during the exam, and get ready to lose some marks. Don't worry, there are difficult questions, but what you guys do by taking tension from that difficult question, you lose the marks. You lose the marks of easy question as well. You lose the concentration for easy question as well. Like the first two were not difficult, but yes, the third one is little bit tricky. This may be tricky. Okay, so let's take a 5 minutes quick break, and then we'll we'll join. Okay. Okay, so let's start this question number 3. And first of all, make your mind that this is a non-routine question. This is a little non-routine question. Okay, because IS 20 itself is a small IS, a one class accounting standard. We cover it in one class. And plus IS 20, normally we use the deferred income approach. Remember, normally we make this entry bank debit and deferred income credit. Please now be all of you be very active. Bank debit and deferred income credit. But sometimes there is a net off approach is applied. Let me revise you complete. Wait. For example, you are buying a machine for 100,000. So first what you do, you buy the machine, you make the entry machine debit, let us say 10,000, and cash credit 10,000. Students, please try to understand. Machine debit and cash credit, you bought the machine. Okay, now on the same date government gave you government grant of 2,000. So you make the entry bank debit 2,000 and deferred income credit 2,000, right? That's how we do it separately. We maintain the machine account separate, we maintain the deferred income account separate. 90% times, 95% time in the exam, these things come separate for machine, separate for deferred income. Okay, but sometimes they give you net approach. See what is net approach. First of all, you bought the machine, and now when you receive the grant, listen, when you receive the grant, you make the entry bank debit 2,000, and you simply cancel the cost of machine. Because just think, because of grant, government help you, so it's basically reduction in your cost. So this is the net off approach. You simply cancel the grant from the cost of asset. I'm sure you have studied or you read this from your book. Okay, this is a very non-routine and one-off approach, but yes, this is part of your course. You don't book deferred income separately. In this second approach, you don't book deferred income separately, you just cancel it with the cost of machine. You just cancel it with the cost of machine. So in this question they are asking about this approach. Okay, first thing. Second thing, I hope you remember the repayment of grant. You have studied this topic, repayment of grant. Okay, repayment of grant. Suddenly sometime you have to repay the grant, sometimes you need to repay the grant, right? So when you have to repay, the grant, it's treated as change in accounting estimate. Repayment of grant is treated as changes in accounting estimate because suddenly you fail to provide the condition, you couldn't meet the condition and you need to repay it. Okay, so this is treated as changes in accounting estimate, is 8. And changes in accounting estimate is always adjusted prospectively. Changes in accounting estimate is always adjusted prospectively. Changes in accounting estimate is always adjusted prospectively. But my dear student, this again repayment of grant topic you have done with deferred income. Many students have done this repayment of grant topic with deferred income, but this time the question says, in this question you have to do this net off approach and there is a repayment. You have to do the net off approach and there is a repayment. So how to do it? Let's try it. My first advice is to take the pick of the question, because I'll change the screen. I'll change the screen to write something. Okay, so it's better you take the pick of this question so that you have this question with you. Now let me read the date. The date is 1st of January X6. This date the story starts. G company received 30,000. This is the amount of grant relating to equipment. Okay, grant related to asset, which cost, the actual cost of the equipment is 90,000 and had a useful life of 6 years. Now, the grant was netted off. See what approach they use, netted off. This approach they use. This is just for example, against the cost of the equipment on 1st of January X7, when the equipment had a carrying amount of 50,000 on 1st January X7. Now see the date again, all of you underline this date, on 1st January X7, that means just after 1 year. We received the grant and we bought the asset on 1st January X6, just after 1 year, when the equipment had a carrying amount of 50,000, its use was changed. We changed the usage so that it was no longer being used in accordance with the grant. That means we breached the condition. We breached the condition of the grant, and I'm sure you have studied this. Whenever you breach the condition, you sometimes ended up with repayment. You have to repay. The grant. So on which date? On which day we did breach? On which day? All of you please check. We did breach on 1st January. We did breach on 1st of January. We did breach on 1st of January X7. Just in 1 year, within 1 year we did breach. Okay, this meant the grant needed to be repaid in full 30,000 by 31st December X7. This has not yet been done. Okay, so obviously we have to pay by the end of December X7, but we haven't paid, so it's your current liability. Don't forget, it's your liability. Okay, right? So first of all, we breached the condition on the beginning of second year. Right? So we have to adjust the figures. Just after the end of first year or from the beginning of second year. We have to adjust the figure as if we haven't received any grant. Okay, that means for the second year we will be booking normal routine depreciation. Now which general entry is required to reflect the correct accounting treatment of the government grant? Read the requirement is very important. Requirement is cash marks each question. The equipment in the financial statement of Gardenberg's company for the year ended 31st December X7. See, We have to record complete accounting for the year ended 31st December X7, one complete accounting entry. Okay. So I give you again 30 seconds to read the question. 30 seconds you have to read the question, and then I'll shift the screen. Okay, I'm sure you have taken the pick of this question. Okay. Yes, it's a little bit technical question. It's a little bit technical. See this. This is can you see this 2 years? My dear students, my dear students, this is the second year, which is our requirement. The second year is our requirement. The second year is our requirement. Okay. But we have to end the story of repayment. We have to end the story of repayment on this day, on this first year, just one on the end, on this first year end. On this first year end, we have to end the story of repayment. Now, just make two columns. In the first column, I'll write with grant. Here I'll write without grant. Try to understand, you'll understand. Try to give some energy. Without grant. Okay. With grant, the cost initially was 90. The cost initially was 90. And they told you that we canceled the 30,000. We canceled the 30,000 in front of the cost. So the net cost for us is 60. And now in this first year we must have booked one year depreciation. So the life is 6 years, you can see. So depreciation year ended December 6 x6 is 60 divided by 10. 60 divided by 10, all of you use your brain. 10,000. So NBV, or we sometimes we use the word NBV, net book value, or sometimes you say carrying value, whatever word looks good to you, you can use. NBV at 1st January, NBV at 1st January X7 is 50. NBV's at 1st January X7 is 50. That means we were simply following the grant accounting till 1st January. But on 1st January we came to know that we have breached the condition. So now we needed to repay the grant. That means now we are without grant. So, and this thing is basically changes in accounting estimate, because suddenly we received this information. This information was not available before. So this is change in accounting estimate. So we need to do something prospectively. Okay. So now let's do it. Let's change the color. The cost is 90,000. Without grant, the cost is 90. And if you just forget about the grant, you have to do depreciation. Year ended December X6, it's 90,000 divided by 6 is how much? 90,000 divided by 6 is how much? 15. Yes, very good, thank you. 90,000 divided by 6 is 15,000. So you will have 75,000. You will have NBV of 75,000. You will have NBV of 75,000. Okay. So first, let's fix the first issue. There are two issues in this question. Let's fix the first issue. Till 1st January. Tell me. Right now the NBV is 50,000, but the NBV the NBV which should have been without the grant, it's 75. So we need to increase the asset by 25. The asset by 25. So wait, don't worry, I'll teach you. I'll fix your issue. So we need to increase the PP by 25,000, PP debit 25,000. Second thing, we booked depreciation of 10, but we should have booked depreciation of 15. We actually booked depreciation of 10, but we should have booked depreciation of 15. So that means we should book now 5,000 extra, 5,000 extra depreciation extra, and no need to do retrospectively as this is change in accounting estimate. So let's book more depreciation expense of 5,000, right? And now you will say, sir, what to credit? Listen, we have to repay on 1st January X7. We came to know that we have to repay complete full grant. So this is your liability. The complete 30,000 is your liability. This entry, just assume this entry you have to make at the beginning of 1st January X7. This entry you have to make at the beginning of 1st January X7. But now the real change, real technical issue in this question. They are asking, you can see you have taken the pick of the question and I'll show you the question. They are asking you for this year. They are asking you till the end of December X7. They are asking you till the end of December X7. So this is one more year, December X7. And now from 1st January onwards, we are without grant. From 1st January onwards, listen, from 1st January X7 onwards, my dear students, we are without grant. We are with, so follow the second column, normal second column. So from now onwards, our per year depreciation is 15. From now onwards, our per year depreciation is 15. So definitely we need to book one more depreciation of 15,000 for December X7. We need to book one more depreciation expense of 15,000. We need to book one more depreciation expense of 15,000 for December X7. Let's book the simple entry. And simple entry, depreciation is your expense. So we'll debit depreciation expense by 15,000. And obviously just made the net entry because of depreciation expense, the value of asset goes down. So your PPE will go down by 15,000. This is the second entry for this year. Now what you have to do, my dear students, just combine these two entry and you'll get full marks. Just combine these two entry and you'll get full marks. Let me change the color. Let me change the color and thickness of the pen. Let me change the color and thickness of the pen. If you have brain, just combine these two entry. Now listen, in the first entry you are debiting PPE by 25. In the second entry you are crediting PPE by 15. So debit PPE 25 and credit PPE 15. 25 minus 15, net impact PPE 10. Okay. Now, in the first entry, depreciation expense is debited by 5, and in the second entry, it is again debited by 15. So 5 and 15, 5 and 15, it's 20. It's 20,000, right? And definitely out of these two entries, there is one thing is common, liability, 30,000. This is the answer of your question. That's it, final, done. Question done. Yes, it's a non-routine question. Yes, it's a non-routine question. I accept. I admit. Sir, what we'll do in the exam? Leave it. Leave it. Just try it and leave it. No issue. 2 marks. 2 marks. Play with the rest of 98 marks. Enjoy the rest of 98 marks. This should be the approach of a good student. No need to cry for 2 marks. Just do charity. Charity. No effect on retained earning because this is change in accounting estimate. Changes in accounting estimate are always adjusted prospectively, not retrospectively. If we do retrospective thing, then dear student, students we do retain anything. Okay, so now we are moving to our question bank. The answer is A. Question number 3, answer is A. Question number 3, answer is A. Now question number 4. You will see some questions are time consuming and some are very fast. You can do it very fast. So this is how we do the average. Listen now, number 4. The following two issues relates to Spyco company mining activities. Number 1, Spyco company began operating a new mine in January X3 under a 5-year government license, which required Spyco to landscape. This is compulsory disposal cost. This is compulsory disposal cost. The area after mining ceased at an estimated cost of 100,000. Yes, wait. I'm sure you all have done either with the name of compulsory disposal cost, or some teachers call it decommissioning liability. It's written in the word also. So yes, this is a pure obligating event. This is a pure obligating event. What is written in the license? That whoever will destroy, whoever will do digging, whoever will destroy, whoever will use this will have to correct it in the end. So now we have just started digging on the day 1. So there is an obligating event. There is an obligating event. So yes, we need to book provision. We need to book provision for this compulsory disposal cost. We need to book provision for this compulsory disposal cost, or you can say, this is decommissioning liability. Yes, provision is needed. Now, number 2. During 2004, Spyco company's mining activities caused environmental pollution. Okay. On an adjoining piece of government land. There is no legislation. So see, they are playing with your mind. Legislation means there is no legal obligation. There is no legal obligation. But I'm sure and I hope that you guys know the meaning of constructive obligation as well. There are two types of obligation. One is legal and one is constructive. One is legal and one is constructive. So let's see, maybe there may be some constructive thing. So there is no legislation which requires Spyco company to rectify this damage. However, Spyco company does have a published environmental policy which includes assurances that it will do so. Yes, so you have already announced it. You have already announced it publicly, the policy. So once you have announced it, it has created a valid expectation. And once valid expectation is created, so there is a constructive obligation. So yes, this is also, in this case, you need to book. In this case also, you need to book the provision. So answer is A. Answer is A. Read it. This was not difficult at all. The first one is about legal obligation and the second one is about constructive. Next one, consolidation. Next one is consolidation. The dates are very important, the acquisition date and all. P company acquired 60%. That means the 40% relates to NCI. On 1st January X7. Wait, the year end is 31st March X7. The year end is 31st March X7. Open your eyes, open your ears, listen. We acquired just 3 months before the year end. Parent company acquired subsidiary company 3 months before the year end. 3 months before the year end. 3 months before the year end. Okay. Now, the following extract has been taken from the statement of profit and loss for the year ended. That means these are complete year cost of sales of P company and complete year full year cost of sales of S company. Now when you do adding together for income statement, we all know income statement is for the year. Income statement is for the year, and in this for the year, P company belongs to us for the whole year, but subsidiary company only for 3 months. So definitely, my dear student, I'll do 3 upon 12 with this. I'll be doing 3 upon 12 with this S company. I'm sure you guys know the rules of income statement. I'll be doing 3 upon 12 with subsidiary company's income statement, but for parent company, I'll write complete. For parent company, I'll write complete. Now, Parkett company consistently made sales of 20,000 per month to S company through the year, throughout the year, throughout the throughout the year, throughout the year, throughout the year. Now, P to S sale, P to S sale is 20,000 per month. Listen, all previous sales are irrelevant. Just after takeover, sales are relevant. After takeover means January, Feb, March. January, Feb, March. Per month sale is 20. Per month sale is 20. So for January, Feb, March, listen to me. Let me make the sketch. See, for January, Feb, March, P2S sale is 20, 20, and 20 is 60. Sales is 60. Sales, actual sales is 60. Okay. Now, at the year end, S company held, how much inventory is held? 20,000 is unsold. 20,000 is unsold. So obviously, this unsold inventory contains the URP. This unsold inventory contains the URP. What? How much markup? Parquet company made a markup on cost of 25% mark on sales to S company. Okay, so here they have given you, the markup, they have given you the markup, they have given you the markup. Okay, so now what you have to do is you have to write SCP, you have to write SCP percentage and dollars. Wait, first of all let me calculate URP and then I'll do the remaining one. This 20,000, see, this 20,000 unsold, this 20,000 unsold inventory is basically cost for S company but selling price for P company. This 20,000 unsold inventory is basically cost for S company but selling price for P company. And how P company calculates, sorry, how P company calculates its selling price? By using markup. So in markup, cost is always 100. This is 25. This is 125. Can anybody tell me the URP? 20,000 divided by 125 times 25. Do it. 4,000, I think. Yes. 4,000 is the URP. Thank you. URP is 4,000. URP is 4,000. Okay. URP is 4,000. Now, can anybody tell me the steps of income statement P2S sale, P2S sale of inventory? For P2S sale of inventory, for P2S sale of inventory, there are only two steps. For P2S sale of inventory, there are only two steps. For P2S sale of inventory, there are only two steps. P2S sale. Number one, whatever is the amount of transaction between P2S, just deduct it from sales, consolidated sales and consolidated cost of sales. First step. The second step is URP is added in consolidated cost of sales. URP is added in consolidated cost of sales. URP is added in consolidated cost of sales. Consolidated cost of sales. Okay. URP is added in consolidated cost of sales. Now listen. Let me do it for you. What is the requirement? What is the Parquet company's consolidated cost of sales? Consolidated cost of sales. So I'm sure you are active. For P company, we'll write complete P company's cost of sales. For S company, definitely as we acquired on 1st January, but the year end is 31st March, so only 3 months. So we'll do S company things 3 upon 12. Let me do it. For parent company, it's 710 plus 480 times 3 upon 12 less, what is this? After acquisition, the sales was 60, so sales will be subtracted, and then URP is 4. URP is 4. Okay, so here you have complete answer. Tell me, 710 plus 480 times 3 upon 12 minus 60 plus 4, 774. 774. Yes, they are asking answer in thousand. 774,000. C is the answer. C is the answer. Look at the screen. Look at the screen. It's not difficult. It's need attention only. This is not difficult. This needs attention only. Okay. Now there are some free marks. I say this, it's free marks. See, a company has decided to change. A company has decided to change. These are free marks, total free to change its depreciation method. You know, depreciation itself is an estimation. We all know depreciation itself is an estimation. So change in the method of depreciation is basically change in accounting estimate. Change in accounting estimate. And whenever there is a change in accounting estimate, it is always adjusted prospectively. Listen, the answer is it is a change in accounting estimate and must be applied D answer. For question number 6, the answer is D. Question number 6, the answer is D. Changes of from straight line to reducing balance, these all are the estimates. These all are the estimates, and changes in accounting estimates are always adjusted prospectively. Even I told you this in the question number 3. Yes, for policy we do retrospective. One guy is asking, for policy we do retrospective. For policy we do retrospective. In my lectures, in my normal lectures, I've given you many examples for change in accounting policies, like revaluation to cost model to revaluation model, first in first out to average cost. These all are change in accounting policies. Okay, again you have question number 7. Question number 7, question number 7. Okay, this is related to IFRS 9. You remember the classes of in IFRS 9? In IFRS 9, when we were dealing with financial asset, in IFRS 9 students, when we were dealing with we were studying financial assets. Listen. So financial asset, there is one class is equity. You can, if you buy shares of another company, if you buy ordinary shares of another company, it's also financial asset. And for that you have two options: fair value through PNL and fair value through OCI. Fair value through PNL and fair value through OCI. Normally fair value through PNL is a short-term category. When you buy it for speculation, when you buy it for short-term trading, you use fair value through PNL. But when you have intentions for long term, then you do election. You remember the word election, and you record it in fair value through OCI, fair value through other comprehensive income. Okay, and once you have chosen fair value through other comprehensive income, then all fair value changes will be reported in OCI. Then all fair value changes will be reported in OCI. So again, a simple question, a simple question. If you know the basics of IFRS 9, you can easily do it. Come on, do it. Start. Included within the financial assets. Correct answer. One guy gave the correct. Included within the financial assets of Zenith company at 31st March X9 are the following two recently purchased investment in publicly traded equity shares. Investment 1, 10% of the issued share capital of Haruka company. This shareholding was acquired as a long-term investment as Zenith company wishes to participate as an active shareholder of Haruka company. It doesn't mean that you have control. It doesn't mean that you have significant influence. It's your trade investment. Right? Okay, and they have written the publicly. So yes, it's long term, so better it's the category is fair value through OCI. The category which fits well is fair value through OCI. Now, the second thing is 10% of the issued share capital, 10% of the issued share capital of Lucas company. The shareholding was acquired for speculative gambling or short-term trading purposes, and Zenith company expect these shares to sell in the near future. So this is most likely to be fair value through PNL. Okay, so now what's the answer? Neither of these shareholding gives Zenit company significant influence. So no significant influence. That's why no associate accounting. Wherever possible, the directors of Zenit company wish to avoid taking any fair value movements to profit or loss so as to minimize volatility in reported earnings. See, these line is very important. Wherever possible, they like fair value through OCI. They love to report the investment in fair value through OCI. So yes, in this first part they will easily get the permission. As the first is long term, they will easily get the permission because it's a long, they will hold. But as the second one, they will sell it immediately, so they won't even get the permission of fair value through OCI. They won't even get the permission of fair value through OCI. So definitely for investment two, they have no option other than fair value through PNL. So the answer is D. Answer is D. For investment one, other comprehensive income, investment two, in profit and loss. How should the fair value movements in these investment be reported to Zenit's company's financial statement? Okay. So the correct answer is D. And many students told me these answers before because this is very easy. This is, you can easily pick it up. You got it? Tell me, write in the chat box. If you guys understood the question, write in the chat box, please. Yes, election is required, but they have not written here. They have written in this part. See, one guy is asking a question. Wherever possible, the directors of Zenit wish to avoid taking the fair value movements to profit and loss. So they will save them by doing election. Obviously, they have not written the word, but these lines are enough. The last lines are enough for election. That means they are indirectly telling you that they will take it to fair value through OCI. Wherever possible, they will take it to fair value through OCI. Now, a lovely question. I would use the word lovely question. Very good question. And I have seen this in final account as well. In real final account question in last 2 years, they give this. Although this is September 2016, at that time, there was no IFRS 16 in your ACCA. At that time, there was no IFRS 16, IS 17 was there, but this part was same in IFRS 16 and IS 17. Let me recall you quickly. After the introduction of new IFRS 16, now 90% leases are finance lease. 90% lease treatment is finance lease, and we book ROU, right of use, and lease obligation. We book right of use debit and lease obligation credit. Right of use debit and lease obligation credit. Okay. And now, according to the new IFRS 16, only there are two possibilities. Where you can use the operating lease. The first one is low value asset, and the second one is if the lease term is less than 12 months. Then you go for operating lease. So for this question, just to make you understand, I'm writing here because this is the old question and I have copied the exact past paper. I'm writing here, this is a low value asset. Okay, this is the low value asset. So that's why they are using, see that lease term is 4 years. So normally it's after more than 1 year. Nowadays more than 1 year is finance lease. But again, if it is a low value asset, keep your concept strong. If it is a low value asset, still you can use the operating lease exemption. Still you can classify the lease as operating lease if it is the low value asset. So just for the simplicity, I'm using the word low value asset, and yes, this is the operating lease question. Now wait, I always teach this thing in my class, and this is your part of your course, and this has been examined. I have seen such past paper. This have been examined. You remember the rent free period? Do you guys remember the rent free thing? Rent free. Listen. See, today I got an asset on operating lease for 3 years. For 3 years. Listen to me. In the first year is rent free, and the second year I have to pay 15, and the third year I have to pay 15, 15, 15 and rent free. 15, 15 and rent free, 15, 15 and rent free. Okay. So my landlord, the lesser told me that if you buy these, if you pay the next 2 years rental, the first year is free. The first year is free. So that means the first year is not free. This is a connected deal. This is a connected deal. So now what IFRS says, so IFRS says, then when there are uneven rentals, uneven means 0 in the first year, second year 15 and 15. So what you do, you add all of these rentals, you add all of these rentals. What is the total value of these three rentals? 0 plus 15 plus 15, 30,000. And then you divide by lease term. In my example, the lease term is 3 years. So you have to book 10,000 expense each year. 10,000 expense here, 10,000 here, and 10,000 in the third year. You all must know IT this in the normal class. This you must know. If 1 year is rent free, don't consider as rent free. You have to equally apportion. You have to book equal apportionment on all years, 10,000, 10,000 and 10,000, right? So in this example, the first year rent was 0. The second year rent is 15,000 and the third year rent is again 15,000. So what you do, this is the case of uneven rentals. Rent free means uneven, 0, 15 and 15. You add all the rentals, and you divide by the lease term, and then you equally book each year. This is what the standard says. See, now let me rub it and let me solve it for you. Wait. Now I'll solve the real question. Your normal rental is, see, your normal rental is, operating lease rental is 5,000 per annum, but you get the cash back incentive of 1,000. See this: 0, 1, 2, 3 and 4. So that means, look at me, in the first year you paid 5, you get back 1. So effectively you are paying 4,000 for the first year, but for the year 2 it's 5, it's 5, and again it's 5. Now you tell me, this is again the case of uneven rentals. This is again the case of uneven rentals. And if you have brain and if you can think, you know why this, the other party gave us 1,000 incentive, because we are taking for 4 years. Why that other party gave us incentive? Because we are taking the asset for four years. So this incentive should be spread over 4 years, not just the first year. This incentive should be spread over the 4 years. And how you can spread it? The same formula I taught you. Add all the rentals. Add all these rentals. Add Whenever there is a case of uneven rentals, add all the rentals. 4, 5, 5 and 5. 4, 5, 5 and 5. It's 19. See this. It's 19,000 divided by lease term is 4 years. Come on, do it. 19,000 divided by lease term is 4 years. Do it. It's 4750 per annum. So what they are asking, what is the charge, means expense, to the statement of profit and loss of Shiba company for the year ended 31st December. We'll book the expense, rent expense, as 4750. This is the answer. This is the answer. C is your answer. C is your answer. So by doing this, we have spread the effect of that incentive, because logically think, they gave us incentive because we took this asset for 4 years. 4. So according to matching principle, According to matching principle, according to matching principle, my dear student, this incentive should be spread over the 4 years. That's what I did. That's what I did. Okay. This is something non-routine for you guys. As as per my research, yes, you can do like this as well. One guy told me just 1000 divided by 4. 1000 divided by 4 is your 250 incentive, and each year 5000 minus 250 will give you 4750. Each year you can do 5000 minus 250, 4750. Your wish. There are different methods. Did you understand this? Did you understand? Okay. So now the next question, question number 9, easy question, not difficult. Tea company operates in emerging market with fast growing economy where prices increase frequently. Okay, that means the prices are going up. Prices are going up daily. Your property is getting more expensive. Your machines going more expensive. Okay, it's the time of inflation. F3 level question. This is, I say this question is F3 level. Which of the following statements are true using historical cost accounting compared 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 to current value accounting in the type of market? Means as compared to revaluation model, you are using cost model. Simplified. In times of rising prices, this is the time of rising prices, and you are using cost model. You are using cost model as compared to revaluation model. Now, just think, in times of rising prices means the cost of the asset is 10,000, but the market value went up to 100,000. Okay, the original cost is low but the market value is high. So if you are using cost model, so capital employed which is calculated using historical cost is understated compared to current. Yes, correct. Wait, the formula, what is the formula of capital employed? Wait, the formula of capital employed is total assets less current liabilities. Students, please look at here. Total assets less current liabilities. Okay, total assets less current liabilities. Now we are not using revaluation model, we are using this cost model. So in times of rising prices, the cost model will give you lower asset value. In times of rising prices, the cost model will give you lower asset value. So when your assets value is low, when your assets value is low, your capital employed is also low. Your capital employed is also low. Your capital employed is also low, right? Okay, so they are saying this thing, this is correct. Capital employed which is calculated using historical cost is understated. They are correct, this is true. Yes. Now, historical cost profits are overstated in comparison to, yes, this is also true. Why? When we are using, cost, when we are using cost instead of market value, so the value of our assets are understated. Value of our assets are understated, so definitely the depreciation expense will be low. When the value of asset is low, so your depreciation expense will be low, and when your depreciation expense is low, your profit will be high. So point number 2 is again correct. Historical cost profits are overstated. Now 3 and 4 is wrong. Simply 3 and 4 is wrong. Answer is A. Read it. 3 and 4 are the opposite things. It's wrong. Oh yes, somebody is asking. Somebody asking a very special question. regarding operating lease. My dear student, we don't book ROU. We don't book ROU in operating lease. So when we don't book ROU, why how can we depreciate? So no more depreciation in operating lease, please. No more depreciation in operating lease. Okay. Now next question is not good. It's very, very good. I love this question. This is a very special question. I love this question. This is a special one. And you know what is this? This is fair value adjustment inventory. Fair value. I need to give a detailed lecture for this. This is fair value adjustment inventory. And just for a reference, in your exam kit, in your past paper exam kit, there is a question peak end. Some sort of some sort peak end adjustment is this. And now many some students gave me feedback in last attempt that this is coming. This fair value adjustment of inventory is coming. So you must know this topic. These are your marks. Yes, it's technical, it's conceptual. Let me start up with a basic lecture first. And but you know, there are different styles. Leave the answer. I don't want answer now. First, I need to give you some lecture. I need to teach you something. Listen, there are different styles of teaching consolidation. Some teachers teaches through double entry, some teachers teaches through BPP approach, and some teacher teaches through Kaplan approach, that a net asset approach. I follow the net asset approach. In last 15-16 years, I taught using these three approaches, but I found net asset approach the easiest and the time saving. So I follow net asset approach. Now wait, let me change the screen. Wait. You know, in SOFP question, how you do it? You make this packet. Remember this packet, acquisition date and reporting date packet, acquisition date and reporting date packet. Listen. And this is your reporting date. Now be a smart learner. This is OSC, ordinary share capital, retain earning, retain earning. Listen. This this is normal thing. Share capital, retain earning. You guys can do it now. Normally it is written about the fair value adjustment. Listen, plant has a carrying value of a plant, or make it land, simple land, carrying value of 2000, fair value is 3000. So now what is this? This is going to be upward fair value adjustment. This is going to be upward fair value adjustment, right? So how you do it? You write here C is equal to A minus L. Listen, C is equal to A minus L. And when your asset is going up by 1000, your net asset also goes up. So how you do it? You write here fair value adjustment plant 1000 here. And now open your eyes. Don't sleep. In 90 or 95% question in your exam, it is written that first dialogue, S company has not adjusted this fair value adjustment by the year end. S company has not in 99% question it is written that S company has not adjusted this fair value adjustment by the year end. So that means in the reporting date packet, in the post period, S company has not recorded. So you need to write this thing in the reporting date. You need to write this thing in the reporting date packet as well. In the acquisition date packet, in the reporting date packet as well. And whatever you write here, you write on the asset side. You write on the asset side as well. I'm sure you know this. Okay. So in 90%, 95% question, this line has written that S company does not know anything about it. S company does not know anything about it. Or they say S company, S company, S company does not adjusted, has not adjusted this by the year end. So you need to adjust in both packets. This is the routine thing. This is the routine thing. But sometimes there is one abnormal question like peak end. Wait. In peak end question, what is the, sometime it is written like this. See, number 2, second. S company has adjusted this FVA in the post period. This is written. This sometime in the question they write this, S company has adjusted. So that means only acquisition date packet you have to adjust. No need to adjust. Just write dash here. No need to adjust anything. No need to adjust anything. And if you are not doing it, if you are not adjusting anything here, you don't adjust anything in the balance sheet asset side as well, because the rule is whatever you adjust in the reporting date packet, you adjust the same in the asset side. So these two things are conceptual. Your concept should be very strong in this. Whether examiner is giving the point number 1 to you or point number 2, these are two different things. Did you guys understand this concept? This is the real concept. I've changed the color of the pen. Now I'm moving towards my real topic. That is fair value adjustment inventory. Listen to me. I'm moving towards my real topic, the fair value adjustment of inventory. Let's start. Wait. Listen to me. Your inventory. Now, listen to me. Listen to me. You know, in individual books, IS2 is applied. IS2 is applied. So according to IS2, inventory is recorded at lower of cost or NRV. We all know this, lower. So at the date of acquisition, S company has recorded the inventory at 100. Yes, they are right. They are right by recording the inventory at 100 in their individual books. But we are parent company. Listen to me, students. We are parent company and we are doing consolidation. So for consolidation purpose, at the date of acquisition, we need to bring complete subsidiary to fair value. Otherwise, our goodwill will be wrong. We need to bring complete subsidiary to fair value. Otherwise, our goodwill will be wrong. Okay. So when you need to bring complete subsidiary companies, so inventory, we also need to bring inventory to fair value. Remember this, don't forget. So now what P company accountant did, 100 was the cost and the fair value is 150. So there is there is upward fair value adjustment of C, FVA inventory 50. Done. Now listen. But sometimes they write in the post period, S company sold all these goods. My dear student, this is truly a conceptual topic, S company sold all those goods in the post period, means now in the individual books as well, S company has booked this profit. When S company has sold means 100 cost was 100 and selling price is 150. So S company has realized the 50 profit. So if these lines is written that all is 100%, all is 100%, so now nothing you need to adjust here. Now in that case, you don't need to adjust anything in the reporting packet, because in the post period S company has booked this profit. S company has booked this profit, complete profit. And when you don't adjust anything in the reporting date packet, nothing to write on the asset side as well. Did you understand this concept? Please tell me. This is very important for a conceptual, those who learn the concept, those who study with concept. This is a technical topic for them. Other guys are not replying. They can't even type. Please reply here on the chat box. I request all of you. Now student, let me change my wordings. What if out of sold, this time I brought you with 100%, what if it is written that sold 70% goods? Means 70% profit is realized, 70% transaction has been done, has been booked in the post period, so remaining 30% is left. So now what you will do, 50 was the original amount, 50 was the original total gain, times 30%. 50 times 30%, you will adjust 15 here, and when you will adjust 15 here on the reporting date, you will adjust 15 on the asset side as well. This is the question which you are doing right now. This is the question which you are doing. Did you understand this last part? If you understood this, you understood the whole question. if you understood this, you understood the whole question. Okay, now let me show you the question. Sorry. Now, okay, I'm giving you 1 minute. I'm giving you 1 or 2 minutes for this question. Come on, do it yourself. These are the year-end inventories number. Let's see how much you guys are smart. I've given you detailed training now. This is not a crash training. This is not a crash course training. This is normal training. First of all, don't do one stupidity. Patila company acquired 80%. Just forget 80%. When we do adding together, we write 100% adding together. You know, adding together is always 100%. So this 80% is nothing. On 1st October X5, at this date, some of Sanka's company's inventory had a carrying amount of 600, but a fair value of 800. So how much is the gain? How much is the fair value adjustment? It's total 200,000. 200,000, you skip 3 zeros, so it's 200. The total fair value adjustment is 200. Okay. Now wait. By 31st December X5, 70% of this inventory had been sold. That means in the post period, 70% transaction has already been done by S company. So you need to adjust only 30%. So you need to adjust only 30% of it. So 200 times 30% is how much? 60. Now, the individual statement of financial position at 31st December, these are the year-end inventories. So you know, you do adding together, 3250 plus 19540 plus this 60. Can you tell me the answer? Thank you. 5250 is the answer A. I hope you understood this concept. I hope you learned this concept. Now 11. Question number 11. With some theoretical requirements. when there is a obvious answer you have, don't go for unobvious answer which are not clear. Okay, for theory requirement, if something is very clear cut written, then go for that answer. Okay. Now question number 11, it's related to your statement of cash flow. And again, I say, again I should say, this is common sense, student. This is common sense. This is common sense. All, let's read it. You have three activities. This one is operating activities, this one is in net answer of investing activities, and this one is finally financing activities. Now what this says, do you think, do you use your brain? Your financing activities are negative. Your financing activities are negative, that means you repaid loan. Just assume you repaid loan, that's why it's negative. You didn't generate any loan. Sometime what happens, that your financing activity is positive and this is negative, that means you have generated finance and you invested in investing activities. Sometime what happens, that your financing activities, are positive, that means you generated new finance and you bought fixed asset, so that makes the sense. But in this question, this is not the case. In this question, you have not generated any additional finance from financing activities, and you are not investing that finance in investing activities. That's not the case. That's not the case. Okay, yes, but that thing is possible, that you earned a lot from operating activities, you earned a lot, big amount, c 995, and then you invest that amount in investing activities, and you use that amount in repaying loan or distributing the dividends. You use that amount in repaying loan or distributed the dividend. That's a possibility. That means you are getting money from your operating activities, you are earning from your operating activities, and through from your operations, you are investing those money in investing activities, and you are repaying loan or distributing dividends from that money. This is a possibility. This may be the interpretation. Okay, so now let's start. Which of the following statement is correct? Means obvious statement we have to give. The company has good working capital management. There is nothing written about working capital, dear student. Nothing. No more inventory, receivables, payables. There is nothing written about inventory, receivables, and payables. How can I say anything? How can I say anything about working capital? So I should not go with this answer, because this question does not relates anything with working capital. So it's better not to take this. Just hold this requirement. Now, net cash generated from financing activities has been used to fund the additions. No, big lie. Impossible. This guy is saying net cash generated. What cash you have generated? It's already negative. Your financing activity is negative. You have not generated any cash from financing. This guy is liar. Point number B is a big lie. Point number B is a big lie. You have not generated anything from financing activities. So it's again wrong. It's pure wrong. Now see, net cash generated from yes, you have generated cash from operating activities. You have generated cash from operating activities. Net cash generated from has been used to fund the, yes, this is total possible. This 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 995 is used in here. Yes, this is a possibility. This is a clear possibility. This is obvious correct. Now, existing non-current asset have been sold to cover the, no. If you have sold existing asset, non-current asset, you get cash receipts. You get cash receipts. So this must be positive. This must be positive. But here you can see your investing activities is negative. So D is also incorrect. D is also incorrect. So the obvious answer is C. The most appropriate answer is C. This is a good question. Now again, a question of common sense. Question number 12. Question number 12. I think it's not difficult. Wait. I'm sure you guys know about the post retain earning. See this. For example, this is only 1 year. 1st January X6 to December X6. Just for your okay. So when it's the only 1 year, and they have given you the retain earning of S company at the beginning and retain earning at the end. So normally the opening, and it's only 1 year. It's only 1 year. It's only 1 year. So when it's only 1 year, so the difference of retain earning is basically S company's profit after tax, or you also call it S company's post retain earning. Both thing is correct. You can call it S company's post retain earning as well as S company's profit after, when there is only 1 year gap. When there is only 1 year gap, so only 1 year is the S company's profit. So you can also call it PAT, S company's PAT, or you can call it S company's profit after tax. Okay. Now let's find out things. Do you know the formula of NCI? Do you know the formula for NCI SOFP? If you are using full goodwill method, if you are using full goodwill method, listen my words. In full goodwill method, NCI is reported at fair value. In full goodwill method, NCI is reported at fair value, but that fair value is always ready-made given in the question, in the plate. But that is of acquisition date. That is of acquisition date. See this. That is related to acquisition date. See, acquisition date 1.1 million. So now what you do? Now what you do? You adjust S company's post profits. You adjust S company's post profits in it. S company's post profits in it. Okay. So wait. If I should write like this: fair value of NCI at acquisition, it's 1100. 1.1 million means 1100,000. Okay. Now add S companies post retained earning. This we have to find. This we need to find. Don't worry, I will find it for you. S companies post retained earning. Now, first of all, they are saying there is some fair value adjustment at the date, at that date, at acquisition date. The fair values of Merrick company, Merrick is your subsidiary, net asset were equal to their carrying value except for this building. See this building, which had a fair value of 1.5 million above its carrying amount, and 30 years is the useful life. Now wait, so you are doing fair value adjustment, you are doing fair value. All questions are not simple, all questions are not like in your study text or exam kit. There may be different questions. So this is upward revaluation, this is upward fair value adjustment, and for upward fair value adjustment there should be some excess depreciation. For upward fair value adjustment there should be some excess depreciation. Let me calculate. Excess depreciation, upward FVA. Wait, it should be, yes, excess or additional depreciation. 1.5 million is 1500,000 divided by 30 years. Can anybody tell me what is the amount? Divide by 30. It's 50,000. It's 50,000. Okay. So this is the additional depreciation which S company has not already booked. So we need to reduce this from S company's profit after tax. S company has already not booked this excess depreciation because S company does not know about this revaluation, about this fair value adjustment. And when S company does not know about this fair value adjustment, so obviously S company has not yet booked this depreciation. So we need to adjust this from S company's profit after tax. We need to adjust this from S company's profit after tax. Okay, boys and girls. Now, what is the S company's profit after tax? Can anybody tell me? This is 3.2 million. Wait, let me write here. This is 3.2 million. This is the amount. Let's start correcting it. Less excess depreciation, which is 50,000. Okay. One more thing. If there is, yes, there is some S2P sale. There is some S2P sale. So you need to adjust the URP. You must have this much concept now. Exams are near, exams are near. If there is S2P sale, S2P sale affects the UR, affects NCI. S2P sale URP always affects the NCI. See, during the year 31st December X6, Marek sold goods to Ronnie. S2P sale, giving rise to an oh, thank God, ready-made unrealized profit 550. So this 550,000 URP will be deducted from this profit. Now, can anybody tell me the adjusted S companies post retain earning? The adjusted S companies post retain earning, it's 2600,000. It's 2600,000. Okay. I repeat, as this fair value adjustment we do for S companies assets, so excess depreciation will also affect the S company's profit. That's why I have subtracted. And the sale which we are discussing right now is S2P sale. The sale which we are discussing right now, it's S2P sale, and we all know the URP of S2P sale affects the NCI. Okay, so your adjusted S companies post retain earning is 2600,000. Now, wait, this is the very famous formula of NCI. Fair value of NCI at acquisition, add S companies post profits, multiply by NCI holding percentage. In this question, our holding percentage is 70. So NCI guys are at 30%. So 2600 times 30% is how much? 2600 times 30% is 780,000. Thank you. Now, can anybody tell me what is the total? 1880. Yes, 1880 000 is the fair value, is the NCI for non-current. I hope you guys got it. You got it? You understood this story? Okay, now moving towards question number 13. Yes, it's a dodge. Easy, the easiest question, but dodgy. There is a dodge in this question. My dear student, hope you remember the thing, gain on bargain purchase, the negative goodwill. The negative goodwill. Sometime what happens is, you listen, sometime what happens, your COI is 100, but fair value of net assets is 150. COI is 100, but fair value of net asset is 150. So you get a negative. Sometimes we call it negative goodwill. Basically, it's gain on bargain purchase. Gain on bargain purchase. Always remember this thing. Listen, this gain on bargain purchase is the income of P company. You can write income, and we simply book it in P&L. Okay. And yes, through PNL it goes to retain earning. Okay, so it is credited to PNL, profit and loss. This answer is wrong. It is credited directly to retain earning. No, not at all. Listen to me. There is a big wait. Let me teach you one conceptual thing. If you make this entry, this is apart from this topic. If you are making bank debit 100 and retain earning credit 100, first entry, and the second entry, bank debit 100 and P&L credit 100. Those who say these two entries are same, they should not give the FR paper. Sorry. There is a big difference. If you make direct entry bank debit retain earning credit without booking in the P&L, that means your EPS your EPS will be affected, and if you make this entry, bank debit and P&L credit, so first you are taking you are booking this gain in the income statement. Your profits will go up, so your EPS will go up, and many ratios, and then through profits it will go to retained earning. So there is a big difference between these two entries. There is a big difference between these two entries. Realize this thing. The first and second entries are different. Booking something directly in retained earning and booking something in P&L, and then through P&L it goes to retained earning. There is a big difference, big difference. Yes, the second entry ultimately retained earning will be affected. I agree. But in the second entry, if you are booking through P&L, your EPS and your profits and everything will be affected. So do remember this thing, that gain on bargain purchase is the income of parent company. Income. And in the consolidated SOCI questions, in the consolidated SOCI, if you have done the exam kit, if you have done the past papers, if you have done the exam kit, if you have done the past papers, if you have done the exam kit of income statement, we book it as other income. Okay. And one more thing, scoring point, I'm telling you, scoring point. Listen. This is no doubt in the question, the holding is 80-20 or 70-30. This is the income of parent company. Let me write. NCI won't get advantage of this income. NCI won't get share because P company bought this expensive. See, the company is expensive. P company bought this expensive company. The real value of this company was 150, but P company, this is the negotiation skill of P company, that they bought this $150 company in just 100. So this income belongs to P company only. No NCI share, not at all. NCI won't get any share for this. Not at all. Don't think over it. You will fail. Okay. So the answer is B. Answer is B for this. Answer is B for this. Okay. Now it's I'm already also very tired now. So I wanted to teach all 15, but let's sum up the class. So all of you are requested to read the exam reports, read the articles, solve the latest past paper, and also solve the question, the last 40 marks on the software, right? Don't do it manually, do it on X. Better you do use the CRA area, constructed response area in accaglobal.com, and practice it, right? Okay. And stay in touch with me in the WhatsApp group. I'll send you all more revision days. I have more revision days with me of consolidation, final accounts, ratios, each and everything. Okay. So stay in touch and be very confident. Be very confident. There are students, they score positions. You have seen scores. They score positions. It's not impossible. It's not impossible, right? And these last days are very important. Don't waste time on anything. Just do productive things, right? So that's it for today's class. Take care and best of luck for your exam.